Hi, everybody. Thank you for joining our third sets of breakout sessions this afternoon. Today's session that you're here for is Forward-Thinking Financing to Building Sustainable Infrastructure. So this session is really aimed at helping us understand how forward-thinking money minds are unlocking innovative financial tools to support sustainable infrastructure projects in Canada's largest P3 sectors. So our moderator today is Johanne Mullen, partner and leader, Canadian Infrastructure and Project Finance Group at PwC, and is also one of our valuable directors here at the Canadian Council for Public-Private Partnerships. Johanne is a partner with PwC and the leader of the Canadian Infrastructure and Project Finance Group and has 20 years' experience in the areas of project finance, structured finance, public-private partnerships, and financial advisory. She is a trusted advisor to both the public and private sectors, structuring and placing financing for large projects in the transportation, health, and urban infrastructure sectors. Johanne is a director of the Institut pour le Partenariat Public-Privé du Québec and a director of the Canadian Council for Public-Private Partnerships. Johanne is a recognized leader in her field, having advised on some of Canada's defining capital projects, including the multi-billion-dollar financing for Nalcor Energy, the MUHC, the Pan Am Athletes Village, Iqaluit Airport, and the City of St. John Safe Clean Drinking Water Program, which was an award winner today. So if everyone can please welcome me in joining and welcoming Johanne Mullen. Thank you.
Thank you. But it's not really about me, it's about them. So thank you, Stephen, for the kind introduction. Maybe just by way of a quick summary of what we're actually going to talk about today. So what do we mean about forward-thinking financing to build sustainable infrastructure? We're going to touch on a few key topics because this is really about innovative ways of accessing funding and financing for projects. So we're going to touch on things like land value capture, tax increment financing, and green bonds. And obviously very happy to broaden the discussion through your questions for the panel. So what we're going to do, just maybe to level set and introduce some of the concepts, we have asked the panelists to do short presentations of projects or themes or structures that they have seen implemented in the market. And then we're going to go to a moderated Q&A and then obviously open the session up to the audience. So I'd like to introduce our panelists. So sitting immediately to my left, your right, is Karen Clarke-Whistler, who is the Chief Environmental Officer from TD Bank. Next to her is Gadi Mayman, who is the CEO of the Ontario Financing Authority. Next to Gadi is Michael Lindsay, who is the Director, Global Infrastructure Advisory Services at Hatch. And Julian Ware, who has kindly come over from the UK, who is the Head of Major Project Funding, Corporate Finance, Transport for London. So please join me in welcoming our panel today. So Karen, I think we are starting with you in terms of a short presentation.
Yep, it actually works. Great. So I was asked to give a little bit of a setup on just what are green bonds and what is the market, and this is a new asset class, and I think there's quite a bit of confusion about it. So I'll just do a little bit of a setup. So here you see where we are with in terms of guidelines around green bonds. This is in general considering an asset class where we're looking not just at financial benefits but other benefits that can be measured, be they environmental or social. There is a group called the Green Bond Principles Group that is a voluntary group of issuers, underwriters, and investors who has formed to try to set some principles around green bonds. And they've got both green bonds and social bonds, which is an emerging side of the equation. But I'm going to talk today a little bit about green bonds. So what is in a green bond? Basically what you see on the screen are the typical categories of project types that would be within a green bond, and that's pretty well becoming standardized. This is the basket. You might see things referred to as climate bonds where they specifically focus on carbon, but it can include anything where you have a measurable environmental benefit. So what is required to make a green bond different than any other sort of bond? And I guess one of the things that I encounter in the bank, a green bond is a standard bond in every way except for the designation of the use of proceeds. So it's not a venture capital fund. These are projects that would fall for us within the bank's risk appetite. They are types of projects that we would be traditionally looking to finance, but they have these measurable environmental attributes. And so in terms of identifying and tracking projects that would fall within a green bond, these are the key elements. The use of proceeds, that has to be identified up front given the criteria that I just showed you. And for us, and probably for most issuers, those criteria go down into quite detailed criteria. How do you measure eco-efficiency? How do you measure whether a project is going to fall into green real estate and that sort of thing? So there are designated use of proceeds. There is then process for project evaluation and selection. Again, typically one would be using an external, some sort of an external agency to review your criteria to ensure that, yes, indeed, this could translate into measurable environmental benefits. The first bond we issued, we used the Canadian Standards Association, but the market in general is moving on to groups that traditionally have been in the certification space. So then the third piece would be the management of the use of proceeds, and this is a pretty important one. Investors want to know that you cannot be parking your money if it's not fully allocated and using it to something that would not meet their criteria. So very important, we set up a segregated account through Treasury, which would hold dollars that aren't allocated, and all the dollars to the green bond would go in and out of there and would be tracked. Last but not least is the reporting. This is an area that I think there's a lot of work being done on right now, but the best practice is now moving towards identifying projects that are held within the green bond, and also being able to give some description of what is the environmental benefit, and ideally being able to quantify that environmental benefit. In our case, we quantify by carbon reduction, and we also do natural capital assessment, which is something our economics team and analysis our economics team has worked on. And we also, as would most good issuers, have the bond assured by our auditors every year to make sure that what we said was in it is actually in it. I guess just quickly, I think one of the pretty amazing things is green bonds really didn't exist before about 2007. They started being issued by groups like the IFC and the World Bank, but we have just seen an incredible appetite for green bonds. And in fact, we're getting up to over 100 billion in issuance this year, and that's basically a doubling of the market in almost 2 years. If you look over to the side at the pie chart, almost half the green bonds issued to date have come out of Europe, but the lighter blue is representing China, the yellow is the US, so you can see that this is really picking up. And I don't expect you to read the fine print, but just as an example, yeah, there you go, put together by my security guys who just like charts. But TD is in the market both as an issuer, as an underwriter, and also as an investor. We did just issue our second green bond, which was $1 billion US green bond. I guess one of the things that, from our insight, we are a highly credit rated bank. So the questions within the bank are, so what is the value add of a green bond? And the short of it is the bond was oversubscribed. We had to upsize it from 500 to $1 billion. It was sold out within an hour. It attracted 10 new investors to the bank. It was par dessus to a vanilla bond. So, I guess that's what, and it was 70% green investors, comparing that to, I think, what others had seen as the most successful green bond from Apple, which was 47% green investors. So we definitely see that for strong companies, there's also that value-added appetite for for green bonds. And why wouldn't you? You've got a strong company and you get the halo effect of environmental benefits. So I think I'll leave it there.
Thank you. I think Gadi's next.
Yep.
Thank you, Karen. So if I can talk a little bit about the Green Bond Program, and I'm going to go through this quickly because Karen's covered off a lot of the important points that I wanted to get to. I just want to be a little bit more specific about what we've done at the province of Ontario. We first started looking at green bonds around 2011, 2012. By 2013, the fall of 2013, the Premier announced that we were going to issue a green bond. And our first bond was issued in October of 2014. So you can see there's a long timeline to this, and it requires a real commitment because for a government, quite frankly, for governments, it's easy to issue bonds, maybe too easy to issue bonds in the current environment. But these bonds, because of the specific nature of what the proceeds are going to be used for, and because of the assurances that are necessary, it takes a long time. One of our biggest challenges has actually been finding the projects internally. It hasn't been the demand on the other side. The demand has been fantastic. The first green bond we did was $500 million, and we had over $2 billion worth of demand. We've done 3 green bonds now. You can see that there are 5 categories that we lay out. These are projects that are eligible, capital projects that are eligible for green bond financing. It's then up to ministries within the government to propose bonds that will be financed in this way. They have to be projects that have already been approved by Treasury Board. So this is not a mechanism to get around government control over what the infrastructure plan is going to be. But as you can imagine, in a $190 billion infrastructure plan that Ontario has over a 13-year period, there's plenty of opportunities there. The bonds that we've done so far, the first 2 categories are clean transportation and energy efficiency and conservation. If I move on to the next slide, you'll see that those are the 2 that have actually been in what all of our projects have been in. So we do have 3 categories that we're keen on finding projects that fit into there. But there's a bit for us, there's a bit of an internal marketing that has to take place as well, because the advantage of it already having been approved by Treasury Board is that we know that these are projects that are priorities of the government. The disadvantage is that the people who have had their projects approved sit there and go, well, what's the advantage to me of doing it through the green financing? We know that we're going to get our financing, and what's the advantage of doing it this way? We think the advantages are actually quite broad. We think that it's helpful in terms of raising the profile of the project, of getting people interested and excited about it. And so we're growing the number of projects that we do have. And you can see there's a wide variety. Eglinton Crosstown is by far the largest. For those of you not from Toronto, that's an LRT line that is going across I'll call it the middle of Toronto. Those from downtown Toronto might think it's a little bit further north, but it's south of where I live, so the middle of Toronto. But we've done a lot we continue to do a lot of transportation, of public transportation, and particularly LRT funding and the Regional Express Rail, which is the electrification of the GO network. But we do have a lot of projects, smaller projects, but really important projects that are energy efficiency. So reducing your carbon footprint through energy efficiency and funding it this way. So that's a general background of what we're doing on green bonds.
Julian's next, but I'll just perhaps to help the audience connect the dots. So right now we're really talking about financing instruments, green bonds. Gadi, you've just talked about how they have gone to support transit projects in Ontario. So, the theme of the panel is innovative financing and funding. As many of you know, one of the big challenges to implementing transit projects is the funding question. So where do we get the dollars? And increasingly, jurisdictions in Canada, and certainly we've seen a huge trend outside of Canada, are looking at innovative ways of finding new funding sources. I won't necessarily call it revenue, but new funding sources, including revenue, land value capture, tax increment financing, to help bridge the gap between what governments can afford and what ratepayers can afford to pay. And that helps then package the project, which then ultimately makes it feasible and then can be eligible for green bond financing. So I'd like Julian to talk to us a little bit about, TFL, Transport for London, certainly through the Crossrail project and other projects, has been a leader globally in terms of looking at innovative funding mechanisms. And I think Julian will probably say, and they've even, even at that, they probably just touched the tip of the iceberg. And I think one of the conversations we want to have with this group today is around how I think in Canada we need to start, opening our minds to other forms of funding for transit and for other projects, and looking increasingly at user pay and so on. So maybe, Julian, I'll pass it over to you. I think you're going to have to skip ahead. There we go.
Okay, so these are my slides. Thank you very much. I'm going to try in about 5 minutes and just introduce the topic of land value capture. I'm not going to talk very much about kind of how we in London got to this point. There's another conference actually in this city a couple of days' time which will look at the Crossrail 1 project and how that has gone and how the funding of that occurred. But I'm going to try and start actually by showing land value capture as a set of ideas. Now, I'm going to do this because personally, having started trying pragmatically, I've come to the bits of theory here and found them useful, particularly if we look at it in an international context. What is land value capture? Well, it's what happens when there is a valuable project, a useful project, two pieces of, in economist speak, market failure, and then in the UK, but not so much in North America, a piece of, I'm going to call it, taxation failure. And let's go through those because they show you the different patterns of what you might expect in different places. First is, you have to have a project that is seen by people as being valuable. If you're building the wrong project, or if you're in a city where nobody really wants to travel by public transportation, I don't think you get started on this. The second thing is that actually you have to charge a lower level of fares than people, or at least some people, would be prepared to pay. And what that then means is that people are prepared to pay in other ways in order to be close to your project, so that the rents or the house values near the project stations increase. And here's the next bit of failure. It's that bit about land that they're not making it anymore. And depending on how restrictive planning, development, zoning is in your city, that will mean that either there is pressure to add more of, development, possibly pressure to build upwards, or if the thing is very restrictive, as is in the case of quite a lot of London, what moves is the price, and the price goes. And then the third bit, fourth bit, is the taxation failure. And in the UK, we are not bad about taxing commercial property, and I'll look at that. So if the value goes up, the tax return changes. But we haven't had a revaluation of domestic property since the year 1990. And the maximum that you'll pay in central London on a mansion in Mayfair, think of your Monopoly board, is just over £1,000. So, in that situation, you'll see that different cities in different places are likely to end up in different spots on the little tube map that we've drawn. And my experience so far has been that outside the UK, in some cities, public transport is not treated as, is not as important as it is in, say, London or Paris or New York, and therefore you don't really get very far down this line. In other cities, actually there is space to develop out, and consequently the pressure with building lines is about expanding the city. In other places, and North America is quite good at this, actually the existing system captures tax receipts from value change quite well, but it misallocates them. They end up in another part of the budget. And a lot of, as I see it, the TIF process is about trying to match those receipts back to the project that caused them. And then in the UK, as I said, you get the position that our taxation is inadequate except a death or a transaction to capture the value, particularly on the residential side. This slide simply takes a couple of our projects We looked at things historically, and then we tried to project into the future. There's a sort of bullseye-like map that shows how close to the station you are and the effect that that's likely to have on your house prices, and a bar chart that shows how particular projects are seen to have affected prices in their area on a controlled basis. So we looked at prices within a kilometre and a half, and we looked at control areas perhaps 2.5 kilometres away. That makes it quite different, certainly from the newspaper coverage in the UK, which just looks at the gross price and doesn't even make an attempt to strip out the effects. What you get out of this one is you start to see where in London, and as I said, these effects will differ very much city by city, but where the gains go. And our experience is that most of the gains go into residential property rather than commercial. Now that reflects the bulk of the development in London being residential. It also reflects the fact we've allowed the commercial market to expand rather faster. And because London's a fairly old city, most of what there is goes into existing property rather than into new. And the little graph at the bottom right shows various UK taxes that I won't bother to go into, but critically the diamonds, which barely get off the horizontal line, show the amount of that the transport authorities, reporting to the Mayor of London, are able to access. So that's land value capture in, I hope, not much more than 5 minutes.
Great, thank you, Julian. Michael, I think maybe to kickstart the Q&A, I know you've worked on land value capture or deals where there was an LVC component in other parts of the world. I think we generally agree that this is still embryonic in the Canadian market. I'd be interested in your views on kind of why that gap currently exists. Do we have more money than we can deal with, and we no funding gap for these projects?
Yes. So these were the marching orders from Johanne, and I said I'd speak to Canadian challenges on the condition that there would be no slides that could be held against me later on. My clients in jurisdictions as far apart as Johannesburg and Calgary are either real estate developers or government agencies trying to do what we would think of as transit-oriented development projects, of which land value capture is one of the things as a constituent element of a TOD partnership that government is interested in. Effectively, these are master-developed communities that have associated transit projects appended to them or running through the middle of them. And before I was at Hatch, I was lucky enough to be at Infrastructure Ontario, where I had a hand with others in trying to do TOD for some of the big transit projects we have in this jurisdiction. I would offer that there are 4 reliable impediments to doing this well in the Canadian market, with sincere apologies to the people that I'm sure I'm about to offend. First of all, governments have a real allergy, I find, to revenue enhancement tools and to user fees, and to thinking through how those things could be an element of a partnership done as between a private sector consortium that's going to build something and develop a community and a public sector entity. Second, because there's always an embedded transit project typically in these master development communities, transit agencies are always involved. And there's a real tension because transit agencies have, at heart, a desire to make sure that they operate well and that their capital bid projects go according to schedule. And the instant you begin to incorporate analysis of the integration, the ancillary or adjacent development of residential complexes or commercial office complexes, transit agencies typically are not incented to care too much about what that looks like, which can lead to a lot of issues as you try to figure out how the technical scope of work for the transit project is going to integrate with the development scope of work. Third, city planning departments typically are sitting on pre-existing master plans for some of these communities to be developed, and it would simply be my observation that oftentimes they're somewhat dogmatic to those plans. They insufficiently take account of the ideas that are being brought to the fore by private consortia about what might be possible, buildable, desirable on any given piece of property. You need that kind of flexibility in order to make this work. And then 4, importantly, I think your process has to be sufficiently flexible so as to allow the right kind of conversations to happen. So one observation, if developers are not involved up front in alignment discussions around where stations are going to go, I would offer that government's already given back lots of the value that it would otherwise create through a partnership. Because the instant you're out there with a defined transit project that has stations in an alignment, the private sector does what the private sector does. It begins to optimize for that. So they purchase land that's within 100 meters, 200 meters of likely stations, then it's very difficult for governments to get the right kinds of conversations going about integrated transit hubs with commercial office space on top of them. 2, there's always a worry on behalf of private consortia that if they're bringing you a great idea, inclusive of some IP that they have that's going to make the community really futuristic and interesting, that they're going to watch as that idea gets genericized by government and slapped into a competitive government procurement process, right? So one of the things government has to get a little bit better at is how do you create the right space for those types of commercially confidential discussions so that you can get those innovative ideas out. And I think the best jurisdictions, they haven't solved it all, but they're starting to make progress against each one of those 4 challenges.
Thank you, Michael. Julian, I want to go back to the TfL example and the Crossrail, because I think you did a great job at the what, so defining LVC. But maybe to address some of Michael's points, I'd be interested in hearing your perspective on how the UK and how TfL went from probably where we are today in Canada to a model where LVC is now actively looked at as a funding tool and a development tool. What was the impetus? How did you get there? What was that process like?
Well, I think it's a journey that, as you say, came through the Crossrail project, and it came by looking at the different sorts of opportunities. So there were, for Crossrail 1, direct development opportunities. There was a bit of a trade-off made in central London about how high buildings should go above new stations. But you'll see over the next few years the Crossrail line emerge and the development immediately around it. So that was the first thing. The second thing was a decision to put up the main business property tax, business rates in the UK, and to extract a hypothecated tax for transport out of business rates to pay 5 billion sterling towards the, 4.1 billion sterling towards the Crossrail 1 project. And that, once a great deal of work had been done on the stakeholders, worked very easily.
Right.
More difficult was creating, at much lower value, only 600 million, a series of systems for getting developer contributions, including effectively a zoning or a planning permission tax across the whole of Greater London. New space, so much a square metre, ranging from £20 to £50, so less than 100 Canadian dollars for a square metre. So though that took more doing, went in, as you start to populate those against that existing new business residential map that we began to carry in our heads, we started to think there is very little happening in the existing residential space. There are very good reasons for that. It's extremely difficult to operate in, but we're beginning to think, is there something that we might just be able to discuss in that area? Because we've done things in the other 3 boxes.
Okay. Michael, you touched on transit-oriented development. Maybe just for the sake of the folks in the room, if you could spend just a couple of seconds defining that. There has been some TOD projects in Canada. Mm-hmm. I know you've seen some across the world. We'd be interested also in your perspective on, is it success factors, or what makes a TOD project a good project, and how do we attract investors?
Sure. So on the question of definition, let me use 2 real examples to try to bring it to life. So some of the TOD partnerships are intensely site-specific. So those of you who are resident of Toronto may or may not have heard about the East Harbour development. It's meant to be in the east end of Toronto at the old Unilever site at the bend, effectively, of the Gardiner to become the DVP. It's going to be one of Canada's largest office complexes. And the notion is that in the basement of that large office complex is going to be a transit hub, effectively that enables regional express rail and other transit connectivity in and out of the downtown corridor. The definition is really that government knows it needs the hub.
Right.
It equally knows that by locating the hub where it's locating it, it is creating a place that has immense value. Socially, economically, commercially, right? So the thought is, why not use these large public use infrastructure projects as the catalyst for the redevelopment of a space like that? So that's a site-specific one. Another example which would be more across the entirety of a linear corridor is in the city of Calgary, the new Green Line LRT is going to run approximately 40 kilometers, I believe, from the northwest to the southeast of the city. It's going through intensely rural communities, suburban communities, and then right down 17th Avenue, right? Mm-hmm. TOD along the line, effectively, both for the sake of placemaking, but equally for the sake of making sure that the city of Calgary, as it locates transit in some of these geographies, is creating the right set of social apparatus that go around those. Equally, they want to make sure that they're doing deals with developers that minimize the total capital subsidy that government requires for this new Green Line, right? So those are the projects. Those are the types of projects. The success factors are in some way the inversion of the challenges that I articulated earlier on, right? Let me use the Green Line again. It just so happens we're lucky enough to be helping the city of Calgary think through this. Rather than getting hyper-specific about an alignment and station location along this entire corridor, the Departments of Planning and Transportation, with a little bit of help from us, broke the line into segments, got crystal clear on what government's objectives ultimately were, social and otherwise, in connection to each one of these segments and the communities that they served, got hyper-specific about some of the social investments they thought would be needed in buildings immediately around these stations, and then went out and through multi-week processes brought in developers, the Brookfields of this world, the First Gulfs of this world, right? And said to them, this is our vision, this is what we'd like to do. In some places it meant integration of development. In some places it just meant that the development was near, right? And they allowed them to effectively opine on that, which got to refined visions that we think have much more potential in terms of being invested. And that was all enabled, or has been enabled, by a willingness of government to effectively create commercially confidential spaces where, around certain sites, they could make credible promises to developers that they were going to have a pretty pointed commercial discussion with them without then revealing the results of that to other players, their competitors. It's been challenging. That's not the way that government likes to operate. There's no doubt about it. But whether it's Phil Washington and the gang in Metro LA with the humbly named Office of Extraordinary Innovation, or even some of what IO has done to create spaces for these kinds of conversations around Port Credit and King Victoria and Waterloo, these are the types of things that at least get you off on the right foot.
Okay. I want to hop back to the green bonds for a second and the financing, because we're talking about the project funding right now. We've talked about transit. And Gadi, you did a really great job, and Karen, at helping us understand the criteria. But practically speaking, if we take Ontario as an example, how does a project qualify for green bond financing?
So, can I step back a second?
Yeah,
and just,
please do.
And just cross over, because I was your first enemy when you listed the challenges. And government is a challenge. Government's just a reflection of the people that vote for that government and the people that they want to vote for them. So the challenge becomes, yes, I want a LRT line, or yes, I want a subway line, or yes, I want RER, or in London there's a network that we're incredibly jealous of here, but still is not sufficient for the needs of a megalopolis like London. But you get two sides to that. You get people that say, well, I'm not going to pay for this 7 years in advance of when I can use it. And so it's not fair to make me pay for it, because 7 years from now, I don't know if I'm going to still be living here or still be doing that commute. So that's number one. The other side of it, once you do build it, people say, well, why should I pay for it? It's already there. And so it's a real challenge. And then this time I'm going to get back to green bonds. The challenge that we face in the world today, it's a good challenge, but we still have, in spite of the fact that interest rates have started to rise, some of the lowest historical interest rates that we've ever seen. And incredibly active capital markets that allow governments and people, as we've seen in the rise in housing prices in a variety of places, to borrow more money than they otherwise would be able to. So there's an easy out for government. The easy out is, I'm not going to tax you yet, I'm not going to toll you yet, I'm not going to do all these things that are going to be unpopular. I'm going to build this, and I'm going to use either regular bonds or green bonds to do it. And so the challenge will be, once that is built, will we be able to then turn around and say, hey, look, we've actually done something. We've made up for this 20 years, 30 years in Toronto and Ontario's case of infrastructure underbuild with 10 years of really dramatic infrastructure build. So now we need people to pay for it. And it'll be interesting to see how that works and how that will then allow the green bonds to be repaid through a means other than refinancing them. So that goes to your question then. And the question is, so what do we do? We start off with, we have, as I mentioned in my introduction, a $190 billion infrastructure plan. Within that infrastructure plan, not all of it has gone through Treasury Board, because that's a plan over 13 years. As items go through Treasury Board, they get approved in Treasury Board, they make it into the budget, and then they go forward. What we say is, okay, once you've got that Treasury Board approval, once this has gone through the eye of the government and said, yes, this is a project we want to do, we'll then look and say, okay, tell us, does this bond actually, or does this project actually qualify for a green bond? Is it sustainable? Does it meet the criteria that we have laid out? And so what we've got is something called the Green Bond Advisory Panel. That panel is made up of people from a variety of ministries that have projects that are potentially available for this. Obviously, the Ministry of Transportation is one of the key ones, but we do have other projects, whether it's through health, whether it's through social housing, and whether it's through the Ministry of Education, Advanced Education, because we built, for example, some projects at some of the colleges. We then choose which ones we're going to, and we fit that to what we think is the available market for the bonds, or theoretically we fit it for what's the available market for the bonds. In fact, what's happened is we've had fewer projects available, or dollar volumes for these projects available, than the ability to actually raise the financing. Green bonds are incredibly attractive to investors, and it's a really interesting dynamic, and maybe Karen will want to touch on this a little bit too, and I'll turn it over to her in a second. When we first started talking about green bonds in 2012, the people at the OFA, the Ontario Financing Authority, that were on the transactional side, the people that actually go out every day and look how to borrow money said, nobody's going to want these things. They're going to say they're less liquid than your regular bonds. They're going to be orphan bonds. They're not going to be great. And so they'll say, yeah, we'll take them, but for 4 or 5 basis points, you pay us 4 or 5 extra basis points to do this, and we'll take it. So that's at the transactional level. I had the advantage of being able to talk to people at more senior levels of the organization than the portfolio managers who sat there and said, you know what? We've signed up for the United Nations PRI, or we're on this panel, we're on that panel. We really need to get out there and be able to say, hey, look, we're part of this. So if you guys do a green bond, we're going to buy it. And so it was an interesting dynamic. So there was a bit of a debate going on between the people that work with me that actually were responsible for issuing the bonds. We said, oh, well, we're going to have to pay 4 or 5 basis points. I said, no, we're going to get it flat. And our target is to actually go through where our costs are. We started off by getting it flat, maybe a basis point more, but recently bonds have come out that have actually been through. And they should be through. By through, I mean a lower yield, so better off for us as issuers. And it should be the case because we're giving something to people that is not only the full faith and credit of Ontario or the TD Bank, we're giving you an extra value. We're giving you something that you can put on your front door as people come in and say, oh, these are green bond investors. Or you can go to, if you're a fund company, you can go out and you can market yourself as having sustainable investments. So it's a really interesting dynamic as this has evolved. So where we've gotten to is we've started off from something which is, oh, why is this different than any other bond? It's different in worse ways. Where you're going to have to give me a higher yield to buy it. To, hey, this is good. We'll buy it and we'll get a yield that's equal or slightly below. Hopefully, we're going to get to the point where we can then and have the projects in place,
Right.
and say, okay, so now you're going to have to pay some sort of charge. Or we have Julian called it a taxation failure, so let's not call it a tax. Let's call it some sort of user fee. You're getting something for this. Let's make use of that. But so I think that's sort of the long stream of where we're going.
Karen, one question that comes to mind, are you accessing a broader investor base through these issuances, or is it the same folks that would be signing up to a regular project bond?
Yeah, so I think, we've now issued 2 green bonds, and the first one we did issue a vanilla bond on the same day,
okay,
because we thought, let's have a look and let's compare. The first bond we did issue, get 7 new investors to TD. This one that we just issued was 10 new investors, which is, big for us. And I think Gadi really hit the nail on the head. I mean, we have the luxury of having a big book of business across North America. We can pick and choose the sorts of projects that go into the green bond. But I think that allows us to really try to respond to investors' needs, which are really getting very significant. I mean, why wouldn't you buy a safe company if you could have this added benefit? And so what we're seeing is as the cycle goes through and as more of these green bonds are being issued, you get big investors, you get the BlackRocks, you get some of the really big ones who are selectively looking out for the green bond. And what that allows us to do is to try to start moving certain sectors.
Right.
So, for example, for us, green real estate is a big holding within the green bond, and that's a pretty conscious effort, because a conscious decision, because if we're looking at trying to move the market to reduce carbon emissions, we know that commercial real estate is a very significant source. So, if we can basically say your project will be in the green bond if it's LEED Platinum, over time, we can start moving the market towards LEED Platinum. And certainly what we see is that the developers that we work with, whereas when we would first approach them and say, would you mind if we reported on your project as part of our green bond? Now they're like, report, and let us know and let us help you. And we can use that to publicize. So I do think as you get more more credible issuers in the market, we are going to, over time, see the market starting to move. And, my fear is we aren't going to have enough projects. And I don't mean we, I mean the big broader investor, there's no shortage of money wanting to come into Canada right now, but there certainly is a shortage of projects. There are only so many. So to all of your comments, this is an opportunity that we need to look, that is there for the taking if we can figure out how to overcome some of these challenges.
So I'll ask the unfair question on that point. And the unfair question is this, and I'm opening it up to the panel for your point of view. So the process as it's been described is projects go through the government approval process. They get approved by Treasury Board, whether they're sustainable, green, or other. And then the projects are assessed to see if they're eligible for a green bond process. I think what we're hearing from a lot of governments is they clearly want to promote sustainable infrastructure. Do you think we can get to a point where, from a capital allocation perspective, one of the criteria as we approve the projects is, would they fit the criteria for the green bond? So, putting the horse in front of the cart rather the other way around. Is that a model that we have seen internationally? Is that something that we think can stimulate the development and approval of sustainable projects?
I'll maybe just kick off and then I'll be done. I do think it's a bit putting the cart before the horse, but on the other hand, I guess I'd have to ask developers the question, why would you build an infrastructure project that did not try to optimize on environmental attributes? Like, why would you do that? It makes no sense. So that's my answer.
Okay.
Yeah. I think it's happening. I honestly think it's happening. I think government agencies are getting better at doing what we would style as triple bottom line assessments of infrastructure projects, making sure that social and environmental impacts are one of those dimensions in the project approval process. I think that's good and should continue. And I think Karen hit the nail on the head. I think that most developers are certainly looking for the reputational benefits as well as the real NPV benefits, right, of developments that are resilient.
Right.
I think that the thing that they often want to talk to governments about is whether they have the same definition of what resilient ultimately is, or the way in which infrastructure will be made resilient. But again, provided there are ways for those conversations to happen, and to happen with a certain commercial edge to them, I certainly don't think that's an insurmountable problem.
We've talked about the criteria and the assessment that's done prior to issuance of the bonds to make sure the project's mapped to the criteria.
Yeah.
And you kind of referred to it in terms of the audit process, but I'd be curious to know, is there an ex-post assessment? And have there been situations, because as you noted, Karen, green bonds have been issued almost everywhere in the world, where project got delivered and the assessment unfortunately concluded that they had not mapped to the original criteria. And then what happens to a bondholder?
I'll start. I think we try to set our criteria so that they're easily quantifiable. So, in terms of renewables, it has to be a pure renewable project.
Okay.
And so the project's either going to get built or not. In terms of something like real estate, it would be designed to be LEED Platinum. Typically, we have construction loans. They're running about 3 years. So we're not necessarily there to see the project finally fully up and running, but we're certainly there checking on our credit every 6 months to see whether there's any significant deviation from design. So pretty much by the time you get building, you're going to be satisfied that the criteria are going to be met. So I think there's a lot in how you define your criteria. I mean, there's some interesting stuff going on right now in China, where if you remember the pie chart that was hard to read, a lot of bonds are being issued out of China. And those are bonds where they're saying it's energy efficiency because we're moving from coal to natural gas. That would not fly here, although we'll see what Mr. Trump does. But, people are buying those bonds in China.
Yes.
So,
yeah. Gadi?
Well, so in terms of the process, the follow-on to the process, so we've got the Auditor General comes in and looks and makes sure that the money is going to the projects that we say the money is going to. Her office doesn't determine whether those projects are sustainable projects, whether they're green projects or not. That's not her role. Her role is to follow the money. And so they do that assessment every year, and that's been good. But what we do is on the other side of it, because we've got to keep our investors satisfied. So we put out a bulletin. We only do it annually. Maybe that's not enough. I think it probably is. And it just traces through where the money has gone, not from a cash flow perspective, but what it's done in terms of the projects and what the results of those projects are. And we do have investors, particularly outside of Canada, who are very, very concerned about this. And they will look, and they speak in front of audiences far larger than this, and they'll say, I don't know if you want to buy another Ontario green bond because whatever. We don't want to get to that point, and we haven't gotten to that point, and we don't expect to get to that point. So there is a very public discussion of what goes on and to make sure that you are following these. One of the things that is looked for is carbon reduction, for example. Now, that's a little bit challenging when we're doing financing for, let's say, the Eglinton Crosstown, which won't be opening until 2021, 2022. So we haven't reduced any carbon yet, and we won't until after that. But we know what the project is. We can describe what the project is and what the life cycle expectation is on that. And that's really important. It's very important to maintain the credibility of the program, because if it fails, then people will not buy those bonds. You had asked earlier about whether it expanded the investor base. It certainly has for us.
Okay.
And it's expanded in two ways. The three green bonds that we've done so far have been in the Canadian dollar market. And one of Karen's slides showed that that was about 2% or 1% of the total global market. Our hope is to grow that market pretty substantially. We think that it should be larger than what Canada's share is of the global market, global fixed income market overall, because we think that we have a specialty niche here, and we think there's a certain attractiveness to Canada as a green place, if I could put it that way. So what we found is by issuing in Canadian dollars, we have gotten not only the people that usually buy our bonds in Canada, we've gotten certain pockets of those investors that are obligated to make investments in the green area. So that goes on top of what they would otherwise buy. But we've also had international buyers, a number of international buyers who either have never bought our bonds, period, or if they have, they've only bought them in their local currency or US dollars. So they bought them in euros, or they bought them in US dollars, but they've never bought Canadian dollars. And so we're hopeful that there's a bit of cross-fertilization here. We get them buying our green bonds in Canadian dollars, and they go, oh, here's a whole new universe of bonds that we can buy. And one of the things that's been really helpful for us, and this sounds somewhat counterintuitive, because usually you want to be in a marketplace where you're the only one there. We don't want to be the only ones here. So we're very happy that TD is here. And we would have been happier if you'd done another Canadian one instead of a US dollar one. But we've seen other governments. We've now had, as of last week, we've now had all three levels of government in Canada.
Because Ottawa came in.
Ottawa came in. So we've now got a municipality. EDC has done one, so that's Government of Canada. And Quebec has done a green bond with us. So a spectrum of bonds, you need that in order to draw in these new players. And so we're really hopeful that continues to help us grow the market.
Thank you. I want to talk a little bit about international precedents. Michael, you you talked about, and Julian did as well, kind of looking at transit development more from a commercial perspective. So whether it be the transit authority or the municipality. And, you know, all kidding aside, some people have referred to MTR as being a real estate development company that happens to offer transit services. But their land value capture program is hugely successful, and they are probably the most profitable transit authority worldwide. Now it is Hong Kong, but that's an aside. I'd be interested to hear from you some examples of and how these organizations transform themselves into really talking about being a developer and using transit to enable development.
Why don't you kick it off?
Ooh. Well, I think that you almost got the answer in the question when you said that, Hong Kong is Hong Kong, and the ability to own most of the land, to manage the development of quite dense, residential and commercial around the lines, and then to use that as a program to hold down the overall failures is tremendous. But it's very hard to replicate in a European or, I suspect, North American situation. I think we can look at aspects of that. We struggle. Gadi talked about the time problem with transport. I think the land value issues play out over a very long time. It's quite often, if you're doing commercial development, relatively risky compared to some of the more taxation-based approaches. But that doesn't mean that it's not worth doing, and it's certainly, I think, worth planning the city, and the railway lines together. We did it in London, but we did it in London in the 1930s when the Metro land put massed housing around new lines but sprawled the city outwards. And after that, we took the view that we weren't going to expand our tube lines and put new housing around them. Instead, we were going to have a green belt around London. We've now sort of filling up the space. London, after a long period of decline, has been growing very strongly over the last 20 years. And we got this question of, what do we do about development? We've been better, probably, in London about what we do in the centre, what we do around commercial development. What we've really struggled with is where do we put the housing? In general, the answer has been on former industrial land. Right. That, too, some people say is filling up. When, in a sense, we know where we want to put the housing, we must link the transport to it, and out of that should come land value uplift and, let's not call it capture, land value sharing.
I mean, so one of my clients, to reference a North American case study, is the Port Authority of New York and New Jersey. We're doing a 30-year master planning exercise for them, and it started with the following premise, that with Panamax and with automation, the lands that the Port Authority of New York and New Jersey owns increasingly will be surplus to requirement.
Right.
And this is all prime waterfront property in and around Manhattan, right? Two things that I'd say. The first thing that's great is that the people who are in charge of the port have been given the freedom to actually think about the art of the possible there, as opposed to, as is sometimes the case, the agencies are asked to do this essentially on the side of the table as they optimize operations. I mean, they've really been given freedom to explore fully what the opportunities are in partnership with developers.
Yep.
And second, I mean, either within the organization or as a function of the things that are done at EDC in New York, they're creating built-for-purpose teams that ultimately have expertise when it comes to development and doing these types of deals, who are being given the discrete ability to ultimately get them done, right? So I think it's all about, do you have the freedom to actually fully engage? And once you do, are you building the right skill sets to be able to do it the right way? Sunnyside Yards in New York is going to be another excellent example of that. Amtrak just found out recently that it's more of a real estate company than it is a railway. And there's a project that they're going to try to do that's 4 times the size of Hudson Yards. It'll create an entirely new community in South Astoria. But it'll be entirely a function, I guarantee you, of A, are they actually allowed to chase it, as opposed to doing a building or two at terra firma as amongst their storage facility. And second, who are the people within the organization or within the broader ecosystem of people on behalf of the mayor and the government of the city of New York who are going to be put in charge?
Yeah, because I think what you're alluding to is to make this successful, you need a governance structure for the development and for the project that gets all of the right players at the table, right? Otherwise, they're at odds. I'd like to turn it over to you guys now with any questions. Also conscious that we're probably keeping you back from the cocktail. But it's a really interesting topic, and I think, you know, the theme of the conference has really been about being forward-thinking and thinking about how we're going to develop infrastructure in the future. And so in my mind, quite honestly, these topics are inevitable. We're going to have to find new ways to fund and finance. And these are just, you know, a couple of those solutions. So I'd be very interested to see if the audience has any questions for our panelists. Or we've been incredibly clear right over there. Do you mind going up to the mic just so that I don't know if it's on.
Yeah, my question is more on the green bonds, because I think the two topics are slightly separate. One is about funding, and one is about financing.
Yep.
But my question is, what level of discount do you think, or if you take green bonds to their ultimate conclusion, will investors give a discount in terms of a return, let's say, for a green bond that's at a particular rating, but because of either the environmental or social impacts of what's being financed, will they give a discount in terms of basis points ultimately?
I think that's a really interesting question, because one of the things that's just starting to happen in the market as it begins to mature is you've now got people like Moody's and some of the others getting into green bond rating. And so they now will be putting their own interpretation of how green a bond is. And I think once you start getting this convergence with some of the major rating agencies, as opposed to, I think what's been happening so far is, people sort of persuading you that their bond is green and they follow the principles. I do think you will start getting a more competitive market. So I could envision that happening. I hope it doesn't happen too soon, because one of the tensions with green bonds is, should we put really strict standards on them? so we can be very clear what is green, what is deep green, what is light green, and what is somebody just greenwashing. And, I think there's a lot of room for people to understand how to basically get what I would call a green revenue stream out of bonds, that I would hate to see it shut down too quickly. That's a long-winded answer. I think ultimately we will get there, but I hope it's not too quickly, that it sort of puts a bit of a lid on the market before it's fully developed.
So just to carry on from where Karen is on that, it's very hard to predict markets, but I think markets tend to strive for equilibrium. And so I think that what we will see is as the green bond market starts to move through, and I think it will move through, and it already, I think, to a degree has, we're probably only talking a basis point or two. And then what ends up happening is financiers like my group will say, oh, well, we should do more green bonds, and that then drives that drives the equilibrium back. So I think that what we'll find is that there is value. We're giving you something as an investor that you don't get with the rest of our bonds. You've got, as well as getting the full faith and credit of the province of Ontario in our case, you're also getting something that I think I talked about before. You can put up by your elevator as people walk in to say this is a green investor. So there's a value there. So I think that value will be paid for by people, but I don't think it's going to be a large amount. I don't think that we're going to see a 5, 10, 15, 20 basis points. I think it's going to be a basis point or two.
Follow-up question. Do you think the Mayor of London would accept a lower land value capture receipt for, let's say, the creation of social housing or something else with a more social purpose?
Well, the answer to that is yes, because what we have quite often when there is planning change is there is also a planning gain.
Yeah.
And in some sense, land value from transport is, part of that. And the current view in London is that for residential land, the bulk of the increase when a new zoning or planning permission comes through should go towards creating a balance of housing, and that is a mayoral priority. He's also very keen on transport. He's keen on the community infrastructure levy, the planning permission tax I talked about earlier, but that's only a smaller element than what goes into the social housing. What does that tell you for green bonds? Over to the others.
Can I offer another example? I mean, in many places that is an explicit trade-off that is happening. I mean, one of the most interesting crucibles in North America right now is Oakland. Oakland, historically impoverished, right? Has over the last 5-6 years watched residential and commercial rents increase by north of 5,000 to 7,000%. As the valley got full, right, and people started to seek a West Coast Brooklyn, effectively, right? There, to Gadi's point before about making sure that you bring local populations with you as you do land value capture, the task has absolutely been to make sure that you were putting a handbrake on land value capture, realizing the benefit that government was getting through that development through means other than dollars and cents for funding for transit projects, right? Social investments around community spaces, rent-control buildings, et cetera. So I certainly think that is within the ambit, right, of what's happening out there.
Well, it's another type of sustainability, right?
Yeah.
It's sustainability of the neighborhood.
Yeah.
For sure. Going once,
There's some on the screen in front of you there, too.
going twice. And with that, I would like you to join me in thanking our panelists. You guys did a great job. It's a really interesting topic, very complex, obviously, but you did a really great job at explaining it for us. Thank you.